Hey everybody, Matt Doyen coming to you from Boston. And the topic today is the 2025 Revenue Trends Report that just came out. So, for those of you who've been following tripleSession for a while, you'll know that we put out a revenue trends forecast for each upcoming year. And usually it comes out right around now, at late October, early November, where we look at the projections for where the market is going, particularly for SaaS businesses and SaaS sales teams. So let me give you the punchline first. Prognosis negative again for 2025. So last year we predicted that the headwinds would continue, revenue efficiency would still be way prioritized over revenue growth, and that was going to result in contraction in sales teams, layoffs, and a number of different ramifications for tech consolidation, stretched sales cycles, lower conversions. Man, we hate to be right on this stuff, but we were right on this stuff. And it looks like next year again is going to face the same headwinds. So it's important to know what's causing this, because it's going to impact how you run your revenue teams, sales and CS mostly, and how it will impact your forecasting and what to expect as you continue to sell into the market. Also, we all sell to the CFO to a certain degree. So the more you understand the revenue implications in the market, the more you're going to be able to explain the value of your offer in spite of all of this, so they can actually make the decision to buy. There is still buying and selling going on, just less of it right now. So what's going on that's driving these behaviors, and how do we know it's going to last again for another year and actually several other years? So number one, we have to look at the investment data. So Crunchbase is great at putting out the updated investment stats, and we can see the capital markets have not recovered since Q1 of 2022. So there was a steady increase through most of the 2000s with some blips along the way. And then a surge of capital during COVID when everything went SaaS. And then the party was over in Q1 2022. And the party is staying over. It's flat to negative for now. How many quarters is that? 10. 10 straight quarters. We are flat to negative with global capital expenditures and investments from venture. To understand why, we have to get beyond the knee-jerk reaction that this is a COVID layover. We have to get beyond anything political. So if you are on the red team or the blue team, I'm sorry to say that neither one of you guys are going to figure this out. Nobody is going to impact the green team on this stuff. The reason why is the capital that's being put into the market, whether it's private or public, all comes, or 70% of it comes from a very tight section of the population, which in the US we know as baby boomers, 55 to 65 aged people that are still in the market, still working, still making huge incomes, and have tons of disposable income that they shove into the market. Well, baby boomers were the largest generation we ever had in the US, and they're retiring en masse. And my generation, Gen X, we're just not big enough to replace that investment volume. And because of that, there's more money coming out of the capital markets than is going in by Gen Xers. And that's going to continue for not just another year, but likely another decade, until the millennials, another big population class, another big generation, start to invest in droves. So because of the less capital in the market, capital is becoming more expensive. The Fed, I know they took a breather on putting up the interest rates. They dialed them back recently. Don't expect that to continue. Capital is more expensive. The Fed is going to make their money. They're going to grab that baby boomer investment capital while they can and give a better rate on things like treasury bills to grab that investment money from baby boomers, because they need to fund the government. So more and more of that capital flight out of the capital markets is going to continue, which means less investment. Less investment will mean less money in the hands of finance. Less money in the hands of finance means just less buying stuff, which means less selling stuff for all of us. So take heed. It's going to be another tough year. hunker down, prepare for it, make the decisions that you need. If you want to grab the full data set and the full presentation on the report, just check out the link below and we'll send it over.